What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Research Survey. In today's episode, Stephen and I will be speaking with Danny Kirsch, head of Piper Sandler's options trading desk, to get his perspective on the recent correction in stocks, why the VIX was still trading at very low levels in February leading up to the tariff announcements, and how institutional investors are using options amidst the market volatility and continued uncertainty around policy. Danny, Stephen, and I have worked together for 10 years. Before joining Piper Sandler in 2022, we worked together at Cornerstone Macro, where Danny also ran the options trading desk.
Danny, I'm super excited to talk with you today. Michael and I have been doing this together for 20 years. I've been in the business for a quarter of a century. I know no one more uniquely positioned to talk about what's really going on in markets today underneath the surface. You're talking to hedge funds, you're talking to risk managers. Can you fill us in on what you're seeing from your chair?
Yeah, Stephen, we've worked together for 10 years. Do you believe that? Doesn't feel that long. It's been a long run.
Feels longer for me, Danny.
Yeah, well, the joke is it feels like 10 minutes underwater. So what we've been seeing the last few days is this, or the last, 3 weeks as part of this sell-off, right? We've had this 10% drawdown. It seemed to start with a real big positioning unwind. You had this weird setup where long momentum and high retail sentiment, there's a lot of overlap in those stocks. Think of names like Palantir, Robinhood, Hims is another one. These aren't like bad companies, they're just bad prices. And so these good companies can continue to rally to insane places. I think like a Hims was tripled over the course of a month and a half. And Robinhood, another name that we like on the fundamental side. We're bullish on the name. But when these names double and triple in a very short period of time and the earnings don't necessarily back them up, you know that there's something else driving the ship. And these aren't even necessarily shorts, but when the narrative changed, or when it changes, or when people start selling, and the narrative started to change when the DoD cut funding, Palantir sells off. And then you start to see other retail sentiment names sell off. And you see this basket that had been on absolute fire to start the year. This high retail sentiment names were up 30, 40%, long momentum of 30, 40%. And then this overlap, when you start getting incremental micro data, the unwind starts. And so a name like Robinhood, okay earnings, not good enough, sold off. Hims, same thing, and they got a bad news on like a GLP-1. They're not going to be able to sell the GLP-1s like they thought they were. Again, stock has 40, 50% downside. Tesla, another name that sort of fit this bucket, down 50% from the high. So you have these names that it was a very frothy market, and you have people very crowded positioning, and again, unique where you had retail and momentum is the same, which I think it doesn't really happen that often, but there's just a lot of overlap in names. And so I think that started this unwind, and now you're adding this massive amount of uncertainty on policy and on trade and what actually is going to happen. And I think it's people are really like hesitant to stick in and buy the dip. And one thing we always look at on the option side and something that gets us bullish or bearish. So August 5th, we had that huge sell-off, right? We had that 3% drawdown, and the VIX got over 50. And it was like the third day in a row we were selling off. And then finally that Monday after the weekend, we really sold off and VIX went nuts. And from our seat, that's bullish. And people have a hard time sort of rationalizing, like, why is that bullish? And it's like, this is working with you, Stephen, and Michael, where you can conceptualize what is actually going on. What got so bad? Are things that terrible? Should the VIX be at 50? And the reason why this is bullish is if you think about it, if you buy a 10 delta put, but it acts like a 25 delta put. So I buy a 10 delta put, stock goes down $1, I should make 10 cents. But I'm actually making 25 cents. So that means someone must be willing to overpay for these puts. And that's how you get the VIX to 50 on a small 3% sell-off. So when that happens, let's say anything positive happens where we get some sort of minor recovery or minor good piece of news that I sold you that put, now I'm hedged on a 25 delta. When the stock starts rallying, that delta will decay super, super fast. So when I sell a put, my hedge is a sell stock. Now, if that delta is decreasing, I need to cover my short stock against my put. So if it goes from a 25 delta to a 10 delta, now I have stock to buy. You can think if you get these blown out volatility and blown out deltas to the downside, any sort of piece of good news is like kindling. While you still need something fundamentally positive to happen, that backdrop is super bullish. You just need any sort of incremental piece of good news to get the market to ramp. We haven't had that yet. This has been much different. The VIX hasn't gotten over 30 yet.
Yeah.
VIX is in the 20s. This is like a degrossing like sell-off. You are selling your stocks, you're selling your puts, to some extent you're covering your shorts. And again, this is why like we are in such a unique position getting to read your work on the factor side and what's working, what's not working. One of the charts we've loved to show is Walmart versus XLP. Walmart being the long in the momentum basket and XLP, basically every single consumer name being short. And there was a period during the sell-off where Hershey's went up like 9 days in a row. And it's just this is so far has really been to me a degrossing positioning story with the sprinkling of uncertainty. And I always you do this great job of flagging what needs to change to get people bullish. And it's like, you need more certainty right now. That's what's driving this is the uncertainty around policy. So I think there's a lot of own goals have happened as far as tariffs. And that's why I'm having a hard time getting super bearish, but perhaps there's more downside, I think, through April. And that's when the reciprocal tariffs happen.
Yeah. So what's interesting is that in that sell-off you're talking about in August, which I guess the market peaked in about mid-July. Everyone's talking about how quick this 10% correction has been. It's been one of the fastest in history. That sell-off, I think, didn't get down to 10%, certainly on a closing basis. I think it was ultimately on a closing basis about 8.5%. But that was certainly, like you're saying, much more violent across and intra markets than what we've seen now, which seems this just steady grind lower. And I think we know the uncertainty. It's surprising that it has actually been more violent, just given that there's so much uncertainty and investors don't really know what to look for to put a bottom in the market. Around that low in August, a few days later, we saw claims. I think we already started the week before seeing claims come down, and they continue to come down. And then by the end of August, the unemployment rate stabilized. So the problem, which back then was a growth scare from 4 months of rising unemployment and claims, really arrested itself and stopped getting worse, and the market bottomed. Now, today, there's not really any data we can look at to say, oh, look, the problem is solved. We're all listening to POTUS and his gang. So can you talk about what was the kind of leading into this? How much were investors pricing in terms of risk in the data you look at before things really started falling apart?
Yeah, so I could say one thing you look at, the VIX was 15 in the middle of February. Now it's 23. Not crazy. Again, in August, it got over 50, and the highest closing price was 40. So I think that they were giving Trump the benefit of the doubt, which I don't necessarily think was the bad choice, because 2017 was the lowest volatility year, I think, ever. We had one, maybe two 1% or greater moves. That was a year we didn't do anything the entire year and then ripped after the tax plan. So I think the initial start was the benefit of the doubt. Until he actually does something, we're going to fade. We're not going to get too bearish. And also the buy the dip mentality has been so strong. And even though the tariffs were coming, I think most people thought there's no way he'll do tariffs on Canada. There's no way he'll do tariffs in Mexico. So I think there was this opportunity for a few weeks to look at inexpensive hedges. And right now, again, even with, and we were talking about this earlier, even with this April 2nd deadline coming, where Trump has said April 2nd will be a huge day. This was a red headline yesterday. We don't see a specific bump in the S&P vol curve. So one thing we do on our desk is we can just, because one of the benefits of zero DTE options, so these 0 days to expiry S&P options, you can just back out 1 day implied moves. We can do it for basically a month, because you need each day expiry, and I think they go out a month. Beyond that, they don't have zero DTs. Basically, taking the difference in implied volatility between today and tomorrow, between Monday and Tuesday, and so far and so forth for the next month, you can back out a 1 day implied move. And for whatever reason, April 2nd, there still isn't a lot priced in. So when we talk to clients, we're pushing them, hey, if you're thinking about hedging, go out to April. You're not overpaying on a vol basis. And at the very least, you know that there's a large macro event covering that will help keep your implied volatility sticky. Because the thing where I think people have a lot of bad memories of using options is when I buy a call option, stock goes up and I lose money. Or I buy a put option, stock goes down and I lose money. And you're like, I'm not touching a put option again. This is horrible. And so what we always look for is what's going to keep that implied vol sticky. And so this April 2nd event is I think, monumental. You're getting a Europe rally today. You're getting a relief rally in S&P today. We'll see if this sticks. So far, these have all been good faith. Maybe this one isn't. I know China's doing more stimulus too. It just, to me, is like this dream of owning Europe, owning China, and selling U.S. It could work, but I think the most likely scenario is if U.S. is going to be on its heels, everything else will be on its heels as well.
Where are you seeing implied risk being priced in the next several weeks?
So there's definitely been a big pickup in implied volatility, like in the semi space specifically. I think it was a fairly crowded long. The other area we saw a huge pickup in demand for downside was HYG, the high yield ETF. I think yesterday was record put volume. And my guess, that's because credit hasn't really done anything. Is that what you're seeing as well? Credit really hasn't moved yet.
It's slowly moving up, as you would often expect to see in a market that's falling, especially based on uncertainty rather than clear data. But yeah, it's still, I don't know, if it was at the 98th percentile in terms of how low spreads were today, maybe it's at the 94th percentile. So nothing really going on there. And I think that makes sense because, again, right now it's more about fear. Historically, when you see that fear spill over into fundamental data and we see the knock-on effects of that, and you start seeing companies say negative things, the data come out more negative, then you tend to see credit react more violently. And in terms of the duration of this move so far, we're just not there yet. Typically takes a few months.
Yeah, and so I think that's maybe the cadence we're seeing. So yesterday, a few clients mentioned who focus on credit that spreads, getting a little softer. Dealers maybe were stuffed with some credit that now they can't unwind. There's like kind of a buyer's strike right now, not necessarily forced selling. And I think part of what happens is you look like, hey, volatility's up, equities are down. Well, I don't think volatility is super high, but it's up a bit. Equities are down 10% off the highs, but credit hasn't moved. If this is going to keep going, eventually credit's going to weaken. So that's the next sort of tool on the toolkit. I'll buy HYG puts. For what it's worth, it's been a while since I've seen someone make money owning HYG puts, but it has happened before. Did really well in 2022, and it was probably better than owning S&P puts, but a lot of that was you made money because rates went up. So you really need rates to stay where they are, and we do have the Michigan inflation data later today. You need rates to stay where they are and credit spreads to widen. I think that's the challenge with using these credit ETFs is when rates are somewhat elevated or higher than they've been, you need to really think that the Fed is going to be slow to cut and credit's going to widen. And I don't remember the last time that really played out that way. It's like when rates are zero, you can have credit widening. You don't have to worry about the Fed sort of stepping in, or you can make a lot of money. In 2022, rates were zero and spreads didn't really need to widen. You just had yields going up, and now you need the Fed on hold. But that could be the situation we're in, right? If inflation still looks sticky, the Fed will sort of be forced to be on hold and you can get some credit weakening. So I think that's the thought process and why you'd own an HYG put for the next few months.
Yeah, I think our view is that until you see employment data, claims, NFP, unemployment, et cetera, which last month's report was fine. You had I think a better expected NFP number than what was feared. The unemployment rate ticked up a little bit, nothing meaningful. And I think that's probably the case that we're not going to see a massive rally in yields until we see more of the activity data in the economy, and particularly employment, really start to more clearly deteriorate. I think that's why bond yields really are stuck roughly at these levels. Today we're at 431. We had a period of time where stocks and bonds yields were falling together. And then we've now seen yields stick around 430 for a couple of reasons. We've had stimulus overseas. We've had some sticky inflation data. And when we look at spreads, high yield spreads, they're at about 335 basis points at the high of that August 2024 sell-off we were talking about earlier. We got a good deal higher. We got all the way up to 381. So we're still well below that, about 50 basis points. And again, back then there was data that was driving the story, whereas today it's uncertainty. So not surprising that spreads are not as wide and volatility perhaps is not as high as those other periods.
Right. And you asked the question earlier, like, where are you seeing risk priced in? Where are you seeing more? And I was thinking about that, and it's in the U.S. European vol is low. Yeah. China vol is low. Everything looks low relative to the U.S. vol. Like we sent something around yesterday, like EFA is developed markets ex-U.S. The implied volatility is super, super low relative to S&P. So that's where the risk is. So if you're trying to think the center cause of what's going on, it's Trump policy. It's like uncertainty in the U.S. specifically. And that's why U.S. vol looks relatively high. It's typically like the trade that volatility guys love to do, sell S&P straddles, strangles, buy anything else like emerging market, buy China vol, buy Europe vol, buy whatever, because U.S. is so safe and everyone will just flag there. There were times where people thought U.S. futures are safer than treasuries. Like those are conversations I've had before in the past. Like the credit quality of Apple is better than the U.S. Treasury. And it's fair. I mean, I think people make that claim oftentimes. So this is very unique. I don't remember a time actually where U.S. was deemed more risky like this relative to everywhere else and just underperforming like this. There's some like really monumental charts on the outperformance of Europe and China and Asia to the U.S. at this point in the year.
It's funny you say that some of those stocks were more safer than treasuries. We've seen over the years the Swiss bank and I think the Norges bank, they've been increasingly owning a ton of these Mag 7 stocks, almost as like reserve assets in their portfolio. And it's big. The Norges bank is one of the top 10 holders of NVIDIA.
Oh, really? There was an article, I think, in the FT talking about them wanting to diversify into a long-short hedge funds, like single manager long-short hedge funds. They think excess returns are maybe we're not going to see those. Like those have all been sort of priced in. And the S&P, I know you don't like looking at valuation, but you have mentioned like when you start bringing down multiples, that's when you get really bad returns. It's not earnings.
Yeah.
It's multiples. And the S&P multiple based on the current earnings expectations, which who knows if those will start coming in, is trading at a 20 multiple. So
yeah, still high. Yeah. Anytime risk shows up, multiples will reflect that and risk premiums will rise. We don't really know right now how much really it's multiples versus earnings, because it usually takes a couple months at least for earnings expectations to start to shift. And this hasn't been that long yet. So I would expect that if this persists, we'll see earnings estimates from the sell side begin to shift, because we'll get into the next quarter's earnings season and companies will start to likely say things that will lead to more uncertainty or potentially more negative outlooks. And then you'll see the earnings adjust. And then we can go back and say, okay, maybe X amount of this was multiples and X amount of this was earnings. But the sequence it's playing out is always the case, but you never know until after the fact.
I think it's like, why would you want to get super long before April 2nd? Like that to me is, well, at least if you're going to start buying stocks, which is fine, and maybe you need to get in front of it and we are off 10%, buy a put and then get long some stocks too. It's like, I don't think volatility is particularly elevated, or buy a put spread for April and SPY, Qs, whatever, IWM. It's still not crazy to me. I went to HYG. Maybe even a VIX April call, like a wingy 40 trick call. The thing is, like puts haven't, out of the money puts, like tails are not super bid yet. And I think that speaks to this degrossing element we've seen in the market. And then after that, then you can start, I think, looking at names to add to the long side. I think financials will be super interesting, because we always think in terms of expiry, third Friday's expiry, prior to April expiry, you're going to get all the large banks reporting. So if I were to like think about how I'd position, be hedged through April 2nd, and then start picking away at financials, which our firm is very bullish on. Volatility reasonable, and they've been killed. They've been a very popular long to start the year. It's been an underperformer. Maybe look at like JP Morgan. You look at like the safe haven names. You can broad instrument XLF, volatility is not crazy, and start looking at upside potentially there to buy the dip. That's how I would, depending on what goes on April 2nd.
With regards to U.S. markets versus the rest of the world, you mentioned volatility is still quite low, and obviously makes sense given the markets there have gone up in Europe, China. In your conversations with clients, is anyone thinking about looking there to buy volatility that is concerned that this is going to last a lot longer? And then ultimately, if U.S. markets keep going down, it's going to bring the rest of the world with it. And therefore, that could be the opportunity, the cheaper opportunity.
So we've seen a pickup in EFA. Like yesterday, there was a large buyer of EFA. Again, this is the developed markets ex-US. It's a lot of Europe and Japan. June downside. So see how this trade war plays out for the next several months. But in China and Asia, it's all upside. It's all calls. It's all call spreads. And I think it's because people are really hesitant to own these underlying stocks because of the policy risk out of China. But they're very open to, I hate to use the word punt, but to get exposure via calls and call spreads. That seems to be the much more popular way to play China. And then if you get that 5, 10, 15% rally due to policy, unwind. And that seems to be this cadence we've seen in China. It's a rent, don't own sort of space specifically. And in Europe, we haven't really seen people chasing upside, and we've seen a little bit of downside. But it's weird. Europe's almost like this space that I think people have haven't had a good experience historically investing in or making money. So far, it's been, we haven't been super active. And that's maybe the one area, the one reason why it could keep going is that you haven't seen a chase at all.
So I'm trying to think this through on how you mentioned there's not really any abnormal risk being priced in for April 2nd, which was an incredible call you highlighted going into the Canada-Mexico tariffs, that there wasn't really much risk being priced in. You're coming up on April 2nd, which would be reciprocal tariffs. You're now talking about a broad swath of tariffs across the globe. Investors aren't really jumping into Europe. There just seems like a lot of disconnects, like either the US has to go down or the rest of the world has to come up. It is a global economy. Where do you think the opportunities are?
So I think investors are jumping into Europe, just not via options. That's what we're seeing. I think that FES is like the Eurostoxx 50 ETF is up 15% year to date. I do think money is chasing there and perhaps being pulled out of the US. So I think that's where people do see that. And they are certainly buying China in lieu of US. My guess is that over the next few months, this policy uncertainty will die down. It doesn't last. And we'll start looking at the tax plan and the potential upside. I think this is going to be like a massive flip. I'm also bullish US. I've always been bullish US, and I know working with you guys, bullish US, and I've yet to see, and maybe it's just in my experience, I started in 2006, I've yet to see anyone make excess returns owning Europe over a long period of time. Maybe this time is different. I'd rather bet on the US, and if you can get in at a really interesting point, I think after April, maybe after May, things settle down and we start talking about really pro-growth tax plan, and maybe this is getting a little bit high on Nancy Supply to the economist here, but this short-term pain, long-term gain. And I think Don on the team had a really nice note about fully expensing factories and structures in the mix and how they're thinking about pro-growth strategies that we can't really talk about now because it's all tariff. This will die out, and there's going to be an incredible opportunity to start getting long U.S. equities. And I think that'll be, I went to it before April, but after April, that's when you really want to start fine-tooth comb, looking through names, looking through the list, like the high-quality growth names that have gotten killed. That's the list that's going to be like gold. And we're going to start thinking about the tax baskets. And we pitched an idea yesterday to get long XLB. XLB is 62% chemical names. No one pitches long chemical. I never remember anyone pitching a long chemical stock. Chemical stocks would be the biggest beneficiaries of this full expensing of manufacturing structures. And those names maybe into next year, which sort of right now are at the heart of all the tariff, the reciprocal tariffs, but into next year could be huge winners that everyone's just missing the boat on. So we like selling June calls to buy like September calls because we think the tax bill will be done mid to late summer. And you're going to start seeing people looking at maybe some cyclical names, some higher quality growth names. And who knows, maybe power plants could be winners if that gets this like full expensing benefit as well. So I just think that there's like a lot of opportunity that's going to present itself in the US after we get through this near-term pain.
How are clients reacting to that messaging?
Oh, people are buying April puts, man. Everyone is like a little bit worried. And again, it's been a lot of pain. It's clearly been a lot of positioning pain. And that the biggest tell for us is market goes down, volatility on a fixed strike basis doesn't go out. When I say that, I mean, you bought a 10 delta put, you're getting 10 delta performance. You're not getting that 25 delta. And that tells me that there's been a really big degrossing that's been happening in the last few weeks. And we've certainly read and heard stories about some long short strategies really struggling and those and that strategy, which has worked really well, especially among some of the larger multi-strat hedge funds, having some near-term trouble. But over time, these do tend to pan out. And I think this will all work after this degrossing plays out. And I would imagine that through April, you'll probably see a little bit more pain and then the opportunities will present themselves.
But so far, you've seen it a lot in degrossing.
Yes.
Not in the frenzied buying of defense.
What we've generally been seeing rolling and adding hedges to the downside or just kind of shrinking portfolios. To some extent, we have had clients who are long stocks looking at, I don't love owning the stock here. I'd consider, though, in the future owning it, so selling out of their stock, maybe buying a call or selling out of their stock and selling a put where I'm okay owning it a little bit lower. So there's been a little bit of picking away at names that maybe are oversold, but I haven't seen like that huge demand to buy. And that also ties in with the put call ratios are keep leaning more and more to the put side.
So instead of the blind by the dip mentality, it's more of a chicken by the dip.
Yeah, to some extent. And it's also shrink your book.
Danny, after big sell-offs the recent years, particularly in 23 and a bit in 24, you saw a big move in small caps. And those of, whether you look at the Russell, was down almost now 20%. So are you hearing or speaking with any clients that, how are they thinking about that space, I guess I would ask?
The usage of IWM, that's typically what we trade because the ETF is so liquid. We see the most volume around things like payroll and CPI, where we will have short-dated call buying to hedge shorts. We haven't really seen this, I want to own IWM here. I think people are more interested in owning SPY or Qs still, even though it's been a bigger underperformer. And the real trades in Russell, I mean, to be fair, 90% of the trades we're doing are puts or rolling puts or adding puts. But when we do have call buying there, it's very short-dated and it's usually for a specific macro event. So knowing that we haven't seen real large stepping in to get along these smaller cap names. And also, I think it makes sense. I'd rather just own like TLT calls. If you're getting bullish because you think rates are going down or something really, I'd rather just own TLT calls and just go direct. And I think TLT could work. I think if you think there's a recession coming, and Besson has said, I want the long end lower, like we want the 10-year lower, just do that. I don't know why you'd mess around in small cap.
Yeah, rates could go down for a lot of different reasons. And right now it seems like they're most likely to go down if growth slows, and that's beta and small caps.
And if that's why you're buying IWM, then that's crazy. And this is like one of the benefits of working with you and reading your work for all these years. It's like, yeah, you could just keep it simple. You don't have to own the small cap. Yeah, there might be a little more torque on the upside, but you can win a lot of ways with owning a TLT long dated call or just TLT right now. And you can sleep at night, which is also nice.
Danny, this has been so informative. Thank you so much for taking the time. I'd love to hear, and I'm sure everyone would, what are you most focused on right now? And for lack of a better term, what's your favorite trade?
So as an optimist, and I do think things will settle down, there's a couple things that happen every year. 4th of July, now we have Juneteenth. We have a lot of holidays in the summer. Some holidays we didn't used to have. And with all of this near-term volatility, longer dated options have gotten more expensive. I think that will change. So we wait to play for things to normalize, but give yourself a lot of time to make money. Buy VIX, July 16 puts for 50 cents. This is just playing for in the next 4 months. We'll look back, we'll look negatively or fondly, whatever is, and all this craziness that's going on now. And then as we're getting ready for our barbecue, VIX will be sitting at 13 and we'll have made 6 times our money. And that to me is the trade of, hey, I think things eventually will settle. And I don't know when, but I think where people make a lot of mistakes is they assume that VIX can only go up fast. It can't go down fast. And the one thing we've seen is that things can change really quickly. And there can be a very rapid move lower in volatility. And over the next 4 months, I'd expect that to happen.
Yeah. The one constant of the last 5 years has been narrative volatility.
100%.
More extreme than I've seen in my 20-year career.
And this is all own goals. Like all of this can be turned around very quickly.
Yeah. And one would think that otherwise would be counterproductive to let the economy really fall out of bed because, like you said, fear is easier to remedy than fundamentals. And right now it's predominantly fear.
Absolutely agree.
All right. Awesome. Thanks, Danny.
Thanks, team. Appreciate it, guys.
Thanks for tuning in to today's episode of What's Next for Markets. Please remember to check out the episode notes on our website, what'snextformarkets.com, for charts related to today's show.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.